Project finance, the invisible engine behind the world's most ambitious infrastructure. Whether it is a power plant, oil pipelines, airport, toll roads, and many more. If it's massive, if it's expensive, and if it changes lives, there's a very good chance project finance made it happen. But what is project finance? In simple words, at its core, project finance is a method of funding large, long-term infrastructure or industrial projects where the loan is repaid not by the companies involved, but by the cash flow the project itself generates. Telling you again, the project repays the debt, not the sponsor, not the shareholder, the project. In a regular corporate finance, for example, say a company borrows money to expand. The lender looks at the company's balance sheet, its credit history, its existing assets. If the company fails to repay, the lender can go after the entire company. But here's project finance flip this model on its head. Here's a simple analogy. Imagine you want to open a new restaurant. In corporate finance, your existing business, your other restaurants, your brand, your personal asset, all of it is on the line. But in project finance, you build a brand new legal entity, a complete separate box, just for that one restaurant. That box has its own bank account, its own contracts, its own debt, and if the restaurant fails, your other business are safe. Lenders can only touch the restaurant's assets. That separate box, that's called Special Purpose Vehicle or SPV. And the SPV is the beating heart of every project finance deal. The SPV, sometimes called a special purpose entity or a project company, is a brand new legal entity created solely to build and operate this one project. It has no other history, no other debt, no other business. It's a clean, isolated legal shell. Why does this matter? There are three reasons to it. If the project fails, the financial damage is contained inside the SPV. The parent companies called sponsor are protected. This is called limited recourse or non-recourse financing. Lenders have limited recourse to the sponsor. They cannot chase the sponsor for full debt unless certain very specific conditions are triggered. Second one is because SPV does exactly one thing. Its cash flow are predictable. Lender can model the revenues, the costs, the risk, everything with surgical precision. There's no noise from other business lines. A small startup company could never borrow 3 billion. But if that startup creates a SPV backed by 25-year government contracted power purchase agreement, suddenly the banks come running. The project's contracts are the collateral. The project's future cash flow are the repayment source. The SPV changes everything about what's fundable. A project finance deal involves a fascinating ecosystem of players. Let's meet them. The sponsor. These are the companies or government entities that initiate the project. They put in the equity, the first loss capital. They want a return on investment. They could be a construction company, an energy firm, a consortium of investors. Sponsors typically own the SPV. The lender. Usually a syndicate of commercial banks and development finance institutions like the World Bank or the Asian Development Bank. They provide the debt, often 70 to 90% of the total project cost. Yes, you heard that right. Projects are highly leveraged. Lender will only lend if they are confident the project cash flow can service the debt. The off-taker. This is one of the most critical player that nobody talks about. The off-taker is the entity that buys the project's output. A power company that agrees to buy electricity for 20 years. The government that agrees to pay for water from the desalination plant. An airline that agrees to use a new airport terminal. The off-taker's agreement, called the power purchase agreement, concession agreement, or an off-take contract, is what makes the project's revenue predictable and therefore bankable. The EPC contractor. EPC stands for Engineering, Procurement and Construction. This is a company that actually builds the thing. They sign a fixed price, fixed schedule contract If they go over budget or over time, that's their problem, not the SPVs. This transfer construction risk cleanly. The operator. Once built, someone has to run it. The operator manages day-to-day operation under a long-term operation and maintenance contract. The government regulator. Especially for public infrastructure, the government may grant a concession, the legal right to build and operate a toll, road, airport, or a port for a fixed term. And then you have the advisor, legal counsel, financial advisor, technical advisor, insurance advisor, all circling the deal, ensuring every risk is identified and allocated. It's the whole universe of player, and the magic of project finance is that every single one of them has a skin in the game. We come to risk allocation, the secret sauce. If project finance has a superpower, it's this. It allocates every risk to the party best able to manage it. This sounds simple. It is not simple. It is the result of months, sometimes years of negotiation. Let's walk through the main risk and who carries them. Construction risk. Will the project be built on time and on budget? Transfer to the EPC contractor via a fixed price lump sum contract with penalties for delays. Revenue risk. Will the project generate enough cash mitigated by the offtake contract? If a government agrees to buy power at a fixed price for 25 years, the revenue is virtually granted. Operating risk. Will the project run efficiently once built, managed by the operator under the performance guaranteed O&M contract? Political risk. What if the government nationalize the project or change regulations? Mitigated by the political risk, insurance, investment treaties, and sometimes the involvement of multilateral lenders like the World Bank. Currency risk. Many projects are in emerging market with local currency revenues but dollar denominated debt, managed through currency hedging instruments or structuring revenues in hard currency. Force majeure, natural disaster, pandemics, war, covered by insurance and force majeure clauses in all project contracts. Now let's talk about money. How does cash actually flows in a project finance deal? It works like a waterfall. Revenue comes in at the top and it flows down through a strict order of priority before anyone sees a profit. Operating cost. First, the project pays its operating expenses. Salaries, maintenance, fuel, insurance. You can't run a power plant without paying the workers. Debt service. Next, and this is non-negotiable, the project pays interest and principal on its debt. Lender get paid before equity holder, always. Debt service, reserve account. Projects are required to maintain a reserve fund, typically covering 6 months of debt payment. Think of it as a financial buffer. If revenue dip one quarter, the project can still pay its lender. Major maintenance reserve, a fund set aside for future large maintenance expenses, replacing a turbine, resurfacing a road. Distribution to equity, only after all of the above are satisfied does the sponsor get the take of their profit. This is called distribution or dividend sweep. This waterfall ensures lenders are protected at all times and lenders monitor it obviously through something called as lenders independent engineer and strict financial covenant. Let's ground all of this in the real world. Abani Group and Canadian Fund. They decide to make a solar farm in Rajasthan. 500 megawatts, enough to power 4 lakh homes for 25 years. Total cost 3,000 crore, that's roughly $360 million. Nobody wants to just write a check of 3,000 crore and hope it works out. Abani Group doesn't want to put the entire risk on their corporate balance sheet. It could sink their whole company if something goes wrong. The Canadian fund manages retirement savings for millions of people. They can't bet it all on one desert solar farm. And the government, they want the energy but they doesn't want the debt either. A new company is created for it. It's called Rajasthan Solar Power Private Limited. Now, Abani Group and Canadian funds puts their money in Rajasthan Solar Power Private Limited, and even the bank can lend them money to this company. So, important point to know is solar panels are owned by the companies. The land lease is in the company's name. Every contract, every single one is signed by this company. Now our SPV needs 3000 crore. Where does it come from? We have two buckets. Bucket 1, equity of 450 crore, that's 15% of the total cost, and bucket 2, debt 2550 crore, that's 85% of total cost. Before any bank agrees to lend, before any equity is committed, one contract has to exist. So Seni Solar comes and signs a 25 years PPA. Then we give a contract to a EPC contractor who says we will build the entire 500 megawatt solar farm for 800 crores and we will finalize it in 18 months. The farm generates 420 crore in revenue every year. Now how does this money move? Operating expense 100 crores, 180 crore to debt service, 110 crores to debt service reserve account. Major maintenance reserve stays 28 crore. We remain with 82 crore. Finally, Abani Group and Canadian funds can take their profit 82 crores split 60 to 40. This is their return on their 450 crores of equity, year after year for 25 years. Thank you so much for listening till the end. Do join us. Thank you.